As we all know, India is an agrarian economy. 58% of the total population is dependent upon agriculture for their survival. Indian government has allocated 1.42 lakh crore in the latest budget for the agriculture sector. Do you know how much has been allocated to the defense sector? It is approximately 3.37 lakhs crore. So, Indian government has seen our security as an utmost priority. If we speak about defense sector comprises of Army, Navy, and Air Force. We can never imagine a navy without warships and submarines. Today, I'll be discussing about a company that provides these kind of warships and submarines to great Indian Navy. And that company has come up with an initial public offer. And that company is Mazagon Dock Shipbuilding Limited. Hi, this is Athul Matthews, Chartered Accountant, and welcome to my video. This is my first video in this series. Kindly like, share, and subscribe. Now let's start with the IPO review on Mazagon Dock Shipbuilders Limited. First, let's go through the IPO details. IPO date starts from September 29, 2020 to October 1, 2020. Allotment date is October 8, 2020. Listing date is October 12, 2020. This IPO will get listed on BSE as well as NSE. This IPO size is rupees 443 crores and this will be entirely offer for sale. What do you mean by offer for sale? Offer for sale is nothing other than the selling of stake of promoters. Promoters are selling their stake in the open market and there will not be any further equity infusion in the company. The IPO proceeds will directly go to the accounts of the promoter of the company. The price band will be rupees 135 to rupees 145 and lot size will be 103 shares. Minimum investment which will be required will be 49,935. In case of an IPO, you cannot apply for one share or two share. You will have to apply for a minimum one lot. That is 103 shares. Maximum lot to a retail investor will be 13 lots and maximum investment with they can apply is 1.94 lakhs. Book running lead managers are Yes Securities Limited, Axis Capital Limited, IDFC Securities and JM Financial Limited. Now let's understand what the company exactly does. The company is involved in the construction and repairs of warships and submarines. 70% of the total revenue is obtained from the shipbuilding segment, while 30% is obtained from the construction of submarines in financial year 20. Company has a capacity of 40,000 DWT. DWT refers to dead weight tonnage. It is a measure of capacity which a ship can carry. And company is promoted by President of India on behalf of Ministry of Defence. And the customer of the company is Ministry of Defence on behalf of Indian Navy. If you look into it, both the customer as well as the promoter is same only, that is Ministry of Defence. And this is the only company that has manufactured conventional submarines and destroyers for Indian Navy. Since 1960, company has built a total of 795 vessels including 25 warships from advanced destroyers to missile boats and 3 submarines. This company is based out in Mazagon, Mumbai and is in the process of setting up another shipyard in Navi Mumbai. They have already been allotted an area of 37 acres in Navi Mumbai and the plan everything is in the initial stages already. There is a lot of locational advantages for a shipyard in Mumbai. There can be close association with the customers, vendors, as well as subcontractors. Most of the vendors and subcontractors of the company is based out in Mumbai. And from the customer side, major customer, as we have discussed earlier, is only Indian Navy. Chief Commander of Indian Navy sits in Mumbai. Now let's understand the journey of this company. This entity was formed in 1774 for servicing the ships of British East India Company. In 1934, this was incorporated as a private limited company and in 1960, this was taken over by Government of India. In 2006, Mini Ratna category status was awarded to this company. What is this Mini Ratna category status? Public sector entities has been awarded with Maharatna, Navaratna and Mini Ratna category status. There are certain criteria in which this status will be awarded. For getting a Mini Ratna category status, this PSU should be earning profits in the past 3 years or should be earning a net profit of more than 30 crores in any of the past 3 years. And we are presently in 2020 and this company is proposes to list in the stock exchanges, that is BSE and NSE, in 2020. If you see, this entity has been in existence for more than or approximately 250 years. We will be able to find out very less number of entities who has been this much long existence. Now let's analyze the order book of this company. This company has a robust order book of 54,074 crores. This order book is entirely from Ministry of Defence on behalf of Indian Navy. The revenue of the company, which has been reported in financial year 20, was 5,000 crores. The order book available with them is approximately 11 times of the revenue which has been reported in the previous year. There is a strong visibility of future in this company. This is a great positive point with regards to this company. But at the same time, there is a single customer concentration risk. Now, let's understand the operating strategy of this company. How did this company get orders? This company is promoted by Ministry of Defence, and the customer available to this company, it is also Ministry of Defence. So, Ministry of Defence on behalf of Indian Navy nominates this company for getting the orders. If there is any proposal for construction of ships or submarines, this company is being awarded the contract without any competitive bidding. There is no competition involved. If such a practice is being followed, there can be compromise in the form of quality and there can be delay in execution. Defense, as I told you earlier, is an utmost priority to the government of India. So, this nomination era is going to see an end. This will enable more private sector players to come into the defense manufacturing sector. The present private sector players who are involved in the defense manufacturing are L&D Shipyard Limited, APG Shipyard Limited, Reliance Defense and Naval Engineering Limited. This change from the nomination era to the competition era is a serious threat to our company for the obtention of the future orders. Now, let's understand the role of bank guarantees for the receipt of orders and advances. If we assume that one order has been received to our company, so what is the next process? They will enter into a contract with the Ministry of Defence or Indian Navy. This contract will specify at what timelines they should execute the project and what are the quality of the project which they have to execute. But what will happen if there is a compromise in the quality or if there is a delay in execution? So the Ministry of Defence will ask for the performance bank guarantee prior to obtention of the contract. So if there is any delay in execution or if the quality has been compromised, there is an option with the Ministry of Defence or Indian Navy to invoke this performance bank guarantee. At the same time, initially for the performance of this contract, some advance would be required to our company. So for release of this advance also, Ministry of Defence or Indian Navy will ask for the advance bank guarantee. Presently in the balance sheet, approximately 11,000 crores has been shown as contract liability, which is the advance received for the contracts which they are proposing to execute over a period of 5 years, 7 years or 8 years. So let's understand next the concept of liquidated damages. If there is a delay in the construction work or the contract which they are undertaking, Mazagon Dock Shipbuilding Company is supposed to pay liquidated damages as per the terms of the contract. This company has already made a provision of approximately 1024 crore in each of the past 3 years. These are the three major important points or risk which we will have to analyze or understand prior to investing in such a company. First is actually competition, second is regarding the invocation of performance guarantee, and third is regarding the huge liquidated damages that may come in future if there is any delay from the side of the company. Now, let's move on to the next slide. We all know that this company is promoted by Ministry of Defence, but we should understand who runs the show. Who is the chairman and managing director of this company? What is his experience? What is the qualification? So in this case, Narayan Prasad is the chairman and managing director, and he has a qualification of bachelor's degree in science or technology, master's degree in mechanical engineering, and a master's degree in philosophy. And he also has served in Indian Navy for over 36 years. I can say that he is having sufficient qualification at the same time sufficient experience to lead the company from the front. Now, let's understand the industry scenario. Whether there's a scope in this industry, who purchases these warships, mainly Indian Navy or Indian Coastal Guard? Presently, they're having a fleets of approximately 135 to 140 as of now, and they are proposing to increase it to 200 fleets. So, who will receive these contracts? These contracts will be received to the shipbuilding industry companies, and our company is one of the major players in this industry. So there is of course a scope, and if you see there is an estimated capital budget up to 2027 of 4.5 lakh crore for the construction of these ships. And if we try to analyze more into the breakup of this budget, 2.2 lakh crore has been given only for the purpose of construction of submarines, and 0.90 lakh has been allocated for the construction of destroyers, and 0.45 lakh constructed for the has been allocated for the purpose of construction of aircraft carriers. So, as I have explained earlier, in India there is only one shipyard which has constructed conventional submarines and destroyers for Indian Navy. That is none other than our company, Mazagon Dock Shipbuilding Limited. If we need to analyze the industry scenario of defense, then we should have to go through the government regulations. Major points which we'll have to be in mind is that this industry has been awarded infrastructure status in 2015. What is this infrastructure status and how does it benefit that company? This is a status which has been given as per the shipbuilding policy in 2015, and the benefit which is arising is that actually the companies involved in this industry will be able to get finance for a long term with very less interest rates. And for that purpose only government has allocated approximately 4,000 crores in 2015. Next is regarding Atmanirbhar Bharat Abhiyan plan. This I think I need not want to explain much because everybody knew the latest plan which has been introduced by our Prime Minister to make India a self-reliant. We should not be depending upon other foreign countries for the as imports. So what all can be produced in India has to be produced in India, and a negative list has been provided by the defense. And in that negative list, if you see approximately 101 item has been included, and this is a major opportunity for the private as well as the public players in this industry. Now the next thing is regarding increase in foreign direct investment from existing 49% to 74%. If you see previously, foreign companies can invest only up to 49%. Presently, that has been increased to 74% stake. There is a huge difference between 49% stake in a company and 74% stake in a company. That is nothing other than the controlling interest. Once this rule comes into the complete effect, there are global giants, for example, Airbus, Boeing, Lockheed, all those companies will invest in Indian subsidiaries because they can control those subsidiaries also. They're having a stake of 74%. They're having huge capital. At the same time, they're having access to the global technology. And our company, Mazagon Dock Shipbuilding Limited, has to compete with such players, and that poses a severe risk to our company. Now, let's move on to my favorite part as a chartered accountant, the financial analysis. Now, let's start with the analysis of profit and loss account. There has been a consistent growth in the top line of company. Company has reported a revenue of 4,470 crores in financial year 17-18. This has increased to 4,613 crores in financial year 18-19, and in financial year 19-20, company had reported a revenue of 4,977 crores. Though, if you see in absolute terms, there has been an increase in operating profit from 260 crores in financial 18-19 to 267 crores in financial 19-20. In percentage terms, this operating profit has reduced from 5.65% to 5.38%. Most interesting factor in this financials is that company is earning a non-operating income of 545 crores in financial year 1920. What is the source of this non-operating income? If we go through the breakup, this is actually in the form of interest income which is being received. Company is maintaining a cash and bank balance of approximately 6,000 crores as on 31st March 2020, and this is the interest income which has been received out of it. Now let's come to the profit before tax figures. Company had reported a profit before tax figures of 735 crores against a profit before tax of 778 crores in financial year 18-19. There has been a slight reduction by approximately 40-45 crores. The major reason is increase in subcontract expenses and decrease in the non-operating income. Subcontract expenses has been increased by approximately 575 crores or 600 crores in financial year 2019-20 compared to financial year 18-19. Complete analysis of each item of profit and loss account is given in the next slide. By analyzing that, you will be able to understand more on this profit and loss account. So the profit after tax without including the profit of the associate is 383 crores in financial 1920, while in financial 18-19 it was 470 crores. There is nothing to get worried because we have analyzed the reasons for the reduction in profit, that is increase in the subcontract expenses and decrease in the non-operating income. Company is having an associate concern, that is Goa Shipyard Limited. This is also a public sector undertaking under the Ministry of Defense. Our company has invested almost 484 crores in Goa Shipyard Limited. After adding up the profit of Goa Shipyard Limited and reducing the other comprehensive loss, company has reported a consolidated final profit of 458 crores in financial year 1920 against a reported profit of 505 crores in financial year 18-19. In this slide, we will be deeply analyzing the profit and loss account. This is just to substantiate what I have informed in the previous slide. Revenue of the company has increased, but profit has reduced. This slide will give the answer to that question. If you see the cost of material sold, that has shown a decrease. It was 68.60% in financial year 18-19. It has come down to 57.56%. Employee benefit expenses has increased by approximately 100 crores. It was 14.94% of the sales, and in financial 1920 it has increased to 15.93 crores. Finance cost depreciation remains almost in the same level. But major changes happened in the subcontract expenses. Subcontract expenses has been reported as 744 crores in financial year 20, while it was only 175 crores, and this is the major reason why the operating profit as well as the profit has reduced in financial year 1920 compared to financial year 18-19. Now, let's analyze the balance sheet of the company for the past 3 years. Net worth of the company has increased from 2,281 crores in financial 17-18 to 2,657 crores in financial 19-20. This net worth has been computed after the reduction of deferred tax asset. I haven't taken deferred tax asset into the consideration because it is an intangible asset and it is an asset which is created out of accounting entries. There can be chances of paying lesser tax, but for my analysis, I'm not taking that into consideration. Now let's go to the other figures. Company is 100% debt-free company. There is neither long-term debt nor short-term debt on the balance sheet dates for the past 3 years. Net fixed assets stands at 926 crore for financial year 1920. Group investments 484 crores. That is the investment in the associate concern Goa Shipyard Limited. And adjusted net worth stands at 2,173 crores. Adjusted net worth is nothing other than total net worth minus investment in the group concerns. Now contract liability stands at 11,383 crores. This is the advance which has been received from Ministry of Defense for the execution of various contracts. Because company has received such a huge amount as advance money, there is a substantial cash and bank balances. Company has a cash and bank balances of 5,798 crores in financial year 1920. This is the major reason why company is reporting a non-operating income of 545 crores in the year. Before going into the inventory, debtors and creditors level, I thought I'll just have an analysis on the net worth of the current year. If you see, net worth of the previous year was only 2,635 crores, and net worth of the current year is 2,657 crores. There is no much increase in the net worth of the company, though a profit of 458 crore was reported by the company. So, where has been this 458 crore utilized? This major portion of the profit has been utilized for the purpose of funding to the buyback as well as distribution of dividends. That is the reason why there is no much increase in net worth, though company has reported a profit of 458 crores. If we come to the inventory levels and creditors levels or debtors level, we can see that there has been an increase in the inventory levels and creditors level, which is not in proportion to the increase in the sales. Inventory levels has increased by 800 crores, creditors levels has increased by 1800 crores approximately. This is actually a concern, and the possible reason for this increase would be COVID-19, as company was shut down during the last 10 days of financial year 1920, and some payments or would be pending from their side. This could be the possible reason, which I think so. In this slide, we will be analyzing the financial ratios of the company. Interest cover ratio stands at 87.81 times. Interest cover ratio represents the earning capacity of the company to pay off the interest. Company is a debt-free company, so debt-equity ratio is nil. TOL by TNW ratio reported is 6.73 times, TOL by adjusted net worth ratio is 8.23 times, and TOL by sales ratio is 359%. This seems to be on a higher side and is alarming and is a concern. But if we go into detail into the operation strategy of the company, which I have explained previously, this is just a common in those kind of companies. Major reason for such an increased liability or increased total outstanding liability by total net worth is due to the presence of contract liability. Company receives advance from their customer, that is Ministry of Defense or Indian Navy, and this has been represented or mentioned in the financials as a contract liability, and that is just a part and parcel of the business. Because of this liability, this total liability has increased to 17,895 crores, and TOL by TNW has increased 6.73 times. TOL by adjusted net worth time is reported at 8.23 times. So I can conclude that this is not an alarming stage of this TOL by TNW or TOL by adjusted net worth. This is in line with the industry for a company which is taking advance from their customers. Now let's do a peer group comparison with the other companies in the industry. We have taken Garden Reach Shipbuilders and Engineers Limited and Cochin Shipyard Limited for our peer group comparison. These two companies, a major stake is owned by Government of India or Ministry of Defense. If we analyze the revenue also, approximately 98% of the revenue of Garden Reach Shipbuilders and Engineers Limited is obtained from Ministry of Defense, while 60% or 55% revenue of Cochin Shipyard Limited is obtained from Ministry of Defense. If we go through the analysis, it is being observed that our company is much better entity than Garden Reach Shipbuilders and Engineers Limited in terms of revenue, profit, operating profit. But Cochin Shipyard Limited stands at a superior level compared to our company in case of net profit and operating profit as well as net worth or in the leverage. But two strong points I just want to highlight in this situation is that our company has an order book of 54,740 crores, which is the reason why TOL by TNW is high, which I've explained to you in the previous slides. This is comparatively higher than the other two companies. And if we really want to look into the future, we'll have to look into the order book. and we have a strong visibility in terms of orders which has been received to this company. And the revenue also seems to be in a higher side, that is 4,977 crores for our company, which is only 3,422 crores to Cochin Shipyard Limited and 1,433 crores to Garden Reach Shipbuilders and Engineers Limited. Now let's go through the strengths of the company. These strengths are already been explained in the previous slides. We'll just go through it. That's all on a very fast basis. This is the only public sector defense shipyard constructing conventional submarines. This is promoted by Government of India. Presently, Ministry of Defense hold 100% stake in this company. This will be reduced to 85% post the IPO subscription. And this company has a world-class infrastructure capable of serving the requirement of Ministry of Defense. Location of facility promotes closer association with vendors and customers. The locational advantages of Mumbai has been explained previously. Then increase in indigenization of vessels and implementation of Make in India campaign, established track record with strong financial position and strong order book, superior liquidity position with adequate cash and bank balances. Now let's move on to the risk involved while investing in this company. COVID-19 impact, but this risk will not be limited to this company, but to the whole in India or to the whole world. And presently, we are moving from a nomination-based era to the competition-based era. Here, actually, there will be a competition from other companies, as I have explained. Other major Indian companies or foreign companies can come into the picture, and there can be possibility of getting less orders to our company. And liquidation damages, invocation of performance guarantee, these are just a part and parcel of the operations. And revenue and order book concentration to a single customer. This company is promoted by Minister of Defense, and the only customer is Ministry of Defense. This is a risk to this company. And decrease in government support to Ministry of Defense. Our government always sees security as an utmost priority, as I've explained previously, and I don't think actually there will be a compromise in our security or the funding which government will make to the defense. And other one is increased trade payables and inventories in financial 20 compared to previous year. As I've explained, the possible reason could be only COVID-19, and if that is the case, actually, this risks are in COVID-19 risk has already been explained previously. Now let's move on to the valuation. Uh, Previously, we have analyzed whether the financial performance of the company is good, whether it is in line with the industry standards, what is the industry performance. If even if all those things are good, if the company is highly valued, the price which the company is requesting from us is very high, it doesn't seem feasible from our side to invest in this company. In order to analyze this, we'll have to go through the valuation metrics. Let's have a brief look on the valuation. If you look into the valuation metrics, earnings per share of this company stands at 21.36. Return on net worth is 15.54%. Net asset value is 152.17, that is the book value. P ratio at the present level is 6.79 times only. If this is being compared with the peers, we'll have a better idea, which has already been listed. So if I compare with the peers, earnings per shares of our company stands at 21.36, while for the Garden Reach Shipbuilding and Engineers Limited it is 14.27, and for Cochin Shipyard Limited it is 48.05. In case of return on net worth, this is on a percentage basis. Cochin Shipyard Limited has a return on net worth of 16.98, while Garden uh, Reach Ship and Engineers Limited has only 7.01%, and our company has reported a return on net worth percentage as 15.54. Net asset value is 152, and that is the book value of the share. P ratio of our company is 6.79, which is comparatively very lesser than Cochin Shipyard Limited. If we compare the average P ratio of Garden Reach Shipbuilding and Engineers Limited and Cochin Shipyard Limited, it comes to approximately 11.60 times. It has to be noted that actually PE ratio is comparatively cheaper to the other players in the industry as well as to the industry average. So we can conclude that the valuation of this company is attractive. Now, let me inform you my decision after doing the fundamental analysis and after analyzing the valuation metrics. This is just my decision, and I'm not recommending you to buy the stock. And this video has been done only for the purpose of educational purpose. For as per the fundamental analysis which I have done, fundamental analysis seems to be satisfactory and the valuation is attractive. So my decision is to subscribe for the listing gains and long-term investments. So you can decide on yourself after doing the fundamental analysis or analyzing the valuation metrics. Thank you.